Beginning of a new financial year when the stock market is down and everybody has this wishful thinking, trying to time the market. Are you also trying to time the market? Well, first afford the market. Trying to time the market is a wishful thinking. A stock market correction is generally perceived to be the time for fresh entry or buying more stocks, right? It's not only seasoned investors, but even the immature ones also try best to time the market. Timing the market is basically making an assessment as to when the market is at its lowest point and is poised for a turnaround. It's a different matter that market has always rewarded those who spend more time in the market than those who try to time the market. Can you time the market this fiscal year? The reality is that even the most seasoned investors fail to time the market. More money has washed out in trying to time the market than the amount of money being made. In his book, The Illusion of Control, John Danielson mocks the attempts to measure and predict the risk and time the market, calling it risk theater rather than credible analysis. He maintains that to properly assess risk, we need to recognize that different investors care about different things depending upon the level of exposure and time horizon. Such accuracy looks impressive but bears little correlation to reality. That said, any market correction at the beginning of a new fiscal year is generally seen as an opportunity for making a fresh entry. This is also the time when businesses close their annual accounts and can assess how much they can invest the profits. The salaried class also get to know the increment and starts assessing cash in hand to invest, and everyone within the built environment of finance knows the corporate earnings start improving by the third and fourth quarter of given fiscal year. It is hence no surprise that across the spectrum of personal finance, the question being asked today are: is the low point of a stock market at the beginning of financial year 25-26 opportunity to buy? Should I enter the stock market now or wait for more correction? Has real estate got into an era of time correction? Has gold reached its peak price point or reached to a fresh high? Which asset class would give best returns in this financial year? How should I evaluate risk-reward ratio? The above questions are relevant not just this time but every time. It is intrinsically wired into the human mind to try to time the market and get the best returns. But the fiscal year 25-26 promises to be different. It's a year when more than whether or not you can time the market, the question that is relevant and more relevant is whether you can afford the market. Not many can afford to buy in today's market, at least not those who are not reckless with money and gamble on every tip here and there. The macroeconomic outlook of India is bleak, and money management of a large share of Indians exposes their risk profile. The average household in the country is today in a debt trap. Some economists even believe there is no middle class left in the country, where 95% of population has absolutely no spending power. In the wealth hierarchy of India, a meager 1% rich are followed by relative poverty and absolute poverty. So you have to assess your finances with a rational mind and not emotional mind. Facts speak for themselves. RBI rings alarm bells against rise in unsecured loans and has called it high credit risk. The RBI has given a stern warning of action against lenders who follow irregular gold loan practices. The RBI has raised serious concern over the surge in unsecured borrowing and speculative trading in derivatives, calling it a worrying sign of euphoria in capital markets. Retail loan has increased from 4% to 11%. 67% middle class have taken personal loans, the most expensive and tricky loans. 25% middle class have taken both credit card and retail loan. Growth of demat accounts have slowed down, and demat accounts are also getting closed now. 45% borrowers in India are subprime borrowers. 48% of the subprime loan is for consumption. Credit and retail loan are at a 10-year high, with not so rosy economic outlook ahead, and where many economists believe recession or prolonged spell of slowdown is looming large ahead. What should be an average salaried class Indians be doing? Should he take advantage of a stock market correction? Should one step up SIP for sizable returns in future? Most of these personal finance questions are more of aspirational questions. These aspirational questions also overlook the much needed financial safety. An average investor must keep in mind that the stock market is a function of profitability. India's corporate earnings are slowing down. Domestic consumption has slowed down. It has significantly slowed down. Private investment is not happening. And geopolitical developments are not so conducive. It is hence no surprise that the FIIs, foreign institutional investors, are also leaving India. They are deserting the Indian market for greener pastures. Personal finance tips for 25-26. The sound advice in today's economic outlook at the beginning of the fiscal year is to be completely debt free. If at all you have a debt, then evaluate whether your debt is leverage or liability. If you are earning more with the borrowed money than the interest being paid, then it's a leverage. However, investing with borrowed money is whatsoever amount you may be earning with that money is a recipe of disaster. Post-COVID stock market gains have lured many middle class Indians to gamble in the stock market with the borrowed money. Many of them have already burnt their fingers. They have paid the price with the market going down in recent times. Since September 2024, actually, the RBI too warns against such a speculative gambling in stock market with borrowed money. What is needed today is assess your net worth. Calculate assets minus liability. Get rid of debt trap. Leverage your loans and get rid of liability. Have emergency fund, term insurance and health insurance. A stock market investment should be with surplus capital and for a minimum period of 3 years. In terms of asset allocation, don't put more than 40% in a stock market. Last but not the least, don't get swayed with FOMO, fear of missing out, when the stock market, real estate or gold starts going up. Similarly, every market correction is time for putting more money if it does not disturb the balance of your portfolio. As of now, the economic outlook is bleak and the fiscal year suggests to be cautious than reckless. I rest my case. Thanks for watching.